2 months into the year, and it has been interesting for investors. Let's get some expert advice now with Chris Dardaman. Chris is the founder of Brightworth, which is based in Atlanta, a wealth management firm there, and it's nice to have you in New York.
Thank you, Rhonda. It's good to be here.
So tell me, at least to start, the temperament of your clients. Are people still very nervous as they have been over the past couple of weeks?
We're seeing a little bit of anxiety among clients, but not near the level that maybe it was back in 2008 or early 2009. But most of our clients are very disciplined long-term investors and understand that volatility comes with markets.
How are you thinking about the way that you advise clients in terms of, we have volatility, so equities, it's tough right now, but at the same time, fixed income has not been a picnic, and those people that are looking for yield are having trouble getting it, and there's some concern about what's happening in high yield, for instance. So how are you having your clients balance these two very big problems now in the market?
It's a great question, and one of the things we do is we set up different buckets for clients based on the time frame that they have to invest. And in the longest bucket, which is equities, we're expecting the highest amount of volatility. In that bucket, for instance, we're looking for opportunities for value. A number of our managers are very value-oriented. They're looking to buy very fast-growing businesses, but only at attractive prices. We have another bucket we call alternatives. That bucket is more designed to get a balance between income-oriented characteristics and growth-oriented characteristics. And those managers have a lot of flexibility. A number of them today are holding a higher level of cash than they normally would, not from a market timing perspective, but simply because they don't have the values that they normally like to see when they buy. The fixed income bucket, we have been more on the defensive side there in terms of short. On the duration side, we have a little bit longer credit maybe than the market, but not a lot. We are overall positioned defensively across the board. We are overweight alternatives and underweight stocks. There's some sectors where we're seeing some value now. Energy is an area that, as we know, has gotten beaten up with oil down about 2/3. But there's starting to be some opportunities. You mentioned high yield, and energy's been one of the biggest detractors in the high yield market. Right. But there are some good opportunities, we think, in high yield outside of energy.
I know, too, that you're thinking about private equity a little bit. So tell me why you're potentially moving in that direction. And let me also ask you, for your clients, private equity, that's a long-term horizon when you invest in PE. So does that work for every client?
The short answer is no, it wouldn't work for every client. But when we think about the equity bucket for our clients, we're thinking longer than 10-year horizons anyway. So on the private side is simply a way of capturing the illiquidity premium, which often can be 300 to 400 basis points of additional return if you're willing to not have daily liquidity. And for money they don't plan to spend for 10 years from now, there's certainly the opportunity to not need daily liquidity there. So we're looking at private equity as a possible addition to our overall strategy to give clients the opportunity to capture those additional returns.
And what kind of returns would be palatable in the private equity space?
The returns in private equity for the very top performing groups have been extremely high. Now, we've been in a good environment for private equity with low interest rates, et cetera. But we think the returns are likely to be lower across all asset classes in the future, not just on the public side, but on the private side as well. But we still think there's a pretty sizable premium to be had on the private side. And the reason is that historically 80% of the returns in private equity have come not from PE expansion, like you'll see in public markets, but it has come from actually them being able to grow the businesses and put together acquisitions and to make the businesses more efficient. So it's a non-correlated return strategy we think that can be a good complement to the public equity markets.
And very quickly, are you worried about a recession at all? Because that's something we've heard a lot of chatter about.
There certainly are some signs that would make us think the economy is slowing. It's still a little early to say, but we would put the probabilities of recession right now at about 30 to 35%.
Chris Dardaman, great chatting with you. Thank you so much.
Thank you, Rhonda.
I'm Rhonda Schaffler for The Street.